Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And this week, while Tori is out of town, Rob was generous enough to give me his time to join me back here in the studio. So thanks again, Rob, for coming. It's been a couple weeks since you and I have gotten to sit and chat back here.
And things went pretty much like we thought they would. Remember, we broke things down seasonally, technically, and fundamentally. Well, the seasonals have come and gone. We are definitely out of the doldrums. You called the technicals. I mean, at that point, we were still a little vulnerable. You know, there was still a possibility we could revert back to around 1860. And then the fundamentals kicked in a day later when the non-farm payrolls came out. And gold reversed back above its support at 1910. And we've been trading between 1910 and 1980 ever since. But I think it wasn't non-farm payrolls that lit the fire under gold. I think somebody knew that 100% of our tax revenues now went to pay interest on the national debt and entitlement payments like Social Security, leaving no more money for running the government, paying the military, anything.
Right.
100% of our tax revenues, and our tax revenues are falling about 20% a month for the last few months.
While spending programs seem to be continuing to pop up for future government acceptance. And I can't remember if it was you and I or Tori and I about a month or 6 weeks ago when we were talking about the debt ceiling. And the argument then was they're looking at raising the debt ceiling from where it is currently to where it could be down the road. But if you do the math, where they're looking at raising it to, they've already spent that money to begin with. And there's additional spending plans on the future. And in a, dare I say, I know we'll probably get canceled if I say the de-depression word, but let's at least call it a recession. It's been like 40 straight months of recession, but we can't call it depression yet.
They're excited, claiming that we only have about a 3% inflation rate last time I checked.
Right.
Which nobody buys into that.
So with all that going on at the same place, it's very frustrated, like you were saying, just in regards to the purchasing power of the dollar obviously declining over the last year. The interest rates, while they did not raise them last month, the assumption is even if they don't raise them this month, they're going to start raising them again. And when we look at the dollar chart here in a second and we start comparing the dollar index, you know, the dollar's relationship on the global market to other currencies, where the dollar is now compared to where interest rates and treasury yields were the last time the dollar was here, and especially the Fed funds rate, which shocked me. The last time the dollar index was at 100. So we've got a lot of things to talk through this week besides gold hitting 1980 and being right about that first little breakout point that I've been looking for.
And we're getting closer. I don't think we have to wait till August.
No, I think our seasonal discussion may have come and gone. You might be right.
Yeah, I think the seasonals are a mood issue now.
So we'll jump into that gold chart here real quick. I will tell you, when I talk to my clients about this, one analogy I like to think of when I'm looking at market charts is I think of market charts in terms of rungs on a ladder. One of my big arguments is when you look at, say, a $500 up and down range in gold. You look at the gold chart over the last couple of years. I see spots in a chart where it's very likely you're going to have stops, pauses, reversals, and then you see periods of air where you're going to have free fall or you're just going to have growth. So that's kind of how my brain pictures it.
And we're not in a free fall scenario right now. We're in a growth scenario.
Right.
Gold's going to re-tap at 2100, and I don't think it's going to fall back.
So the reason we talked about that 1910 for so long is because that, to me, was the first real rung in the ladder.
Right.
That was the first kind of
And it almost
ledge.
didn't hold. It almost didn't hold. We were vulnerable when we broke below that.
And granted, it still might not. You know, there's a couple things we need to see on the upside. I know I'm the eternal curmudgeon. I drive everybody here crazy because I'm always micromanaging everything.
Well, I think the fundamentals are now in charge. I mean, $1 trillion annual interest payment, what's our revenue? 4?
Right.
Yeah, or 4 plus. So we're over 20% of our annual tax revenue just to pay the interest on the national debt.
Yeah, I think they're estimating 4.7. I looked at this last week. I think it was 6.2 outflows and 4.7
Inflows.
inflow.
So we're over 20%.
Yeah. So significant.
That's
and
huge.
Fiscal year comes to an end, I think, in October. So
Right.
we're going to know here by November, December what the fiscal year numbers actually ended up being.
We're going to know what they let us know.
Okay, fair. $30,000 for a hammer at the FBI? Yeah, I don't think so. So back at this gold chart, and one of my big fears in any market is I don't like runaway markets. I like
Right.
healthy, happy markets.
Everybody
I'm a
does.
gold owner. I
Yep.
want gold to go up. I want my stock to go up. I want my house to go up. I want all my assets to make me money. I get it. I'm right there with you.
On a logical progression, not
Exactly.
not a moonshot.
And that's what I'm getting at. We didn't want gold to take one step down. We wanted gold to take a couple steps down.
That would have been perfect.
And we only got one so far.
I think we saw the low for the middle of the year.
And we might have.
Yeah.
And that's scary bullish.
Well, the fundamentals are now in charge. The seasonals are done. I think technicals are pointing higher.
So if you look at the gold chart over, say, the last number of months, and you look at the highs back in April and May, where I'll draw this on the chart here, as you can see, there's what I like to call the neck. You have a head and a neck. The neck is sort of the breakdown point that you can see. We held it here in the middle of April and then eventually broke it at the end of April, beginning of May. Well, that was right at 1980. That's where we're at now. So this is that old adage of old highs become new lows as gold pushes up. Now we're seeing a little bit of a ceiling here, but only over the last 2 days.
Yeah.
So
we just
what?
got
Gold
here.
paused.
Yeah.
I mean, by the time this show goes live on Thursday, we could be back above it. And if that's the case, I think you're already looking at breakout territory, and it's only July.
I know. And people are still on vacation.
Oh, yeah. And we haven't even started the next seasonal thing, which historically in the precious metals industry kicks off with the Indian wedding season. So monsoon, harvest, wedding season, a lot of gold gets bought over in Asia, and that tends to kick off here in the next couple of months, which traditionally for decades has been relatively positive for the precious metals market. Now we look over at silver, and silver started singing this story back at the beginning of June. While we were watching gold still come down, we were expecting to see silver come down to a long-term rising trend line, which it never made it to.
Well, you were thinking around $22.
Yeah, I was thinking we might hold around $22 for a month or so and eventually meet that trend line.
And boom, it was up $1 in one day.
Yeah, and now we're up over 25.
Yep.
So $3, that's 22. That's what, 13% in a couple weeks. So silver, we
Long
get
overdue.
$26, $27, which
Long
could happen
overdue.
in 2 weeks.
Yeah,
Or-
long overdue.
Or 2 hours, depending on things have been going. Now all of a sudden we're at significant breakout territory in silver. So we're seeing the same story across the board. You know, we spent the first half of the summer going, okay, we know we're in a pullback in a long-term bull market. How far are we going to get? And what if that was it?
I think it was.
So why is this all happening?
Fundamentals.
That's where you started, right? Why is all of this happening? Because we're seeing it in the equities market too. The Dow, the NASDAQ, the S&P. The NASDAQ obviously has been strong for a while, but it's way overbought and it's going to have a pullback.
Oh, yeah.
Like who cares? But the Dow isn't overbought yet, even though it's been climbing, and the S&P isn't overbought yet. Now, granted, all three of those indices are about 4 or 5% off the previous highs, so they still have a way to go, just like gold does.
Mm-hmm.
But we're seeing this investment return across the board, whether it's in protective assets like precious metals or speculative assets like equity investing. Why?
So much money. There's so much money out there. And they're going to be printing more.
And what scares me about that is at what rate are they printing it? That's where I start getting real concerned. You know, when you open the show discussing this concern we have over the spending of the U.S. government compared to the income, when we get into, and again, I didn't want to say the D word, but let's at least say the R word, recessionary, like you mentioned, tax income is going to continue to decline in the United States. Now, we can have a reshuffling of what we spend money on, but most of it is going to the types of services that I can't imagine they're going to move money away from. Social Security, healthcare benefits, Medicare, Medicaid, and military's on the list, although it's not as high on the list as I think our more liberal friends think it is. So between those four things, that's the bulk of our spending budget as a country.
And then what about our personal budget? You got to put food on the table, gas in the car. You got to go see the doctor.
Right.
Used car prices are falling. Commercial real estate is cratering right now. Headlines are full of people leaving the keys in mailboxes for high-rise buildings in downtown cities.
Mm-hmm.
It's just getting started.
So you start raising interest rates to attempt to do a couple things. You want to curtail inflation, but that's going to require the other side making more austerity-based decisions, which we're not seeing.
I think the Fed's going to have to start increasing the balance sheet. That's one avenue they can take that people don't really track.
Yeah, and that's the next thing on the list. So you raise the interest rates. That's one thing you can do, but you have to have the others. You've got to have the government spending play ball. So that's two.
Not happening.
You've got to have the Federal Reserve lower the balance sheet, which
Not
they
happening.
have admittedly tried to start doing.
They tried to, but I think that card is off the table now.
Right. And you have to encourage foreign investing in the U.S. dollar, treasury bills, treasury bonds, so on and so forth.
The de-dollarization with the BRICS countries is taking that off the table as well.
So here's our dollar index chart. This, for me, is kind of the point of the week I'm looking at. Here's our dollar index chart. We did break back below 100. Now we're just barely above 100 on the dollar index right now, but we did break back below 100 here this week. Actually, it was last Friday. We are at the lowest value since April of last year. So the dollar is the weakest it's been in the last 15 months. So 15 months ago, the Fed funds rate was 0.35%. It is currently 5.08.
Wow.
So we're right back to where we started, and the federal funds, the internal lending rate is 15 times what it was then.
Wow.
Now, granted, 5% doesn't feel like a lot, but compared to what they could get away with 15 months ago.
Well, that argues against my point of that there's so much money out there. It's not free money anymore.
No, but they're still asking for it, and they don't mind spending it because they're not going to have to deal with the repercussions. And on top of that, now you look at the bond yields, which is something you and I like to look at whenever you come on the show. So the Fed funds rate is up 15-fold. So the bond yields must be up 15-fold because that's going to encourage foreign investing in the dollar and the treasuries to help prop up and offset some of the spending the government's doing.
Bond yields are falling.
Yeah, well, you go back to about the same period. So about 15 months ago. Now, the bond yields started moving up a few months before they started raising interest rates in anticipation. We all knew. So let's actually not use April because that's cheating. Let's go back to middle of 2022 when they were on the floor. And you're looking at a pretty massive spread. I mean, you're looking at the 1-year bond yield at just over 0. It was about 0.2%. And the 30-year is at 2. And that's when Fed funds rate 0.35. So interest rates are 0, bond yields are 0, a 30-year bond is 2%. That's completely reasonable. Well, now interest rates are 5. So you would assume bond yields are probably somewhere between 8 and 15%.
They're below
I mean, when
4.
you look at the math.
30 years below 4.
30-year is 3.8, 10 years 3.7, 5 years 3.9. In fact, the 1 and the 2-year are the highest.
Yeah.
So 1 year's over 5. 2 years about 4.7. But the relative increase between the borrowing rates and the lending and savings rates are dramatically different. So if you lived in Europe right now and you were looking to diversify some of your assets for growth purposes into a safe asset, it's not the treasuries. I mean, you're buying treasuries because everybody owns a little bit of everyone else's debt. But they're not at rates that are going to bring in significant foreign investment that's going to help offset and bring assets into the U.S. to offset the increase in government spending, which is already well over 100% of revenue. And revenue's falling, like you just said. So I don't know, man.
What could go wrong?
Well, I own gold, so not everything can go wrong. A lot's still going to go wrong.
Yeah.
But at least I've got a little bit that's going to offset that.
That's what it's for.
So crazy story these days, how all the pieces of the market are kind of coming together like a puzzle. The next 6 months are going to be telling.
Yes.
So, Rob, thanks for helping me keep my thoughts straight. I've been staring at a lot of numbers for the last couple of weeks. I'm actually glad you brought up the government spending thing, because I was on the government spending website where they have that really cool graphic where you can go like click on this box and it breaks down all the Social Security spending, and then go click on this box. So I've been watching a lot of this stuff as I've seen gold kind of start climbing over the last week, and just thinking,
somebody else is watching too. And I think that's what lit the fire under gold. Somebody else was adding the numbers up, going interest payments, entitlement payments, nothing left for anything else.
Right.
Tax revenues falling. This is not good.
Yeah. So we can just get together every 3 months and raise the debt ceiling again, because that apparently is going to work forever.
And raise the Fed balance sheet. They're going to have to.
Yep. And that might be the end.
Yeah.
That might be the end of the attempting to save the market cycle, and they may have to just 2008 and let it play out for 9 months.
Yeah.
Just sometimes you got to let the dust settle. And we may be facing the next period of letting the dust settle. That's where my head's at. Super Captain Optimism, as usual. So anyway, thanks again, Rob. I appreciate it. This has been Golden Rule Radio, your weekly recap of the precious metals markets. So thank you for joining us here on YouTube. If you liked what you heard, you can head on over to our website. We can be found at McIlvaney.com. We're also on Twitter at ICA Gold and Facebook at McIlvaney Financial. As always, if you'd like to talk to Rob, myself, or any of the other advisors here at McIlvaney Precious Metals, we can be reached at 800-525-9556. Thanks for listening. Have a great week.